So you're wanting to invest in the stock market, but perhaps you don't know where to start and you're intimidated by all these fancy new words. Or maybe you heard it's just too risky and don't want to lose all of your money. Well, don't worry, because we're tackling all of that and more in my ultimate guide on how to invest into ETFs for beginners. I'll even walk you through step by step on how to purchase your first ETF investment. This is the video I wish I saw before I started investing over 7 years ago. And we're going to be breaking this video down into 7 simple steps, starting with understanding what investing is and what it is not. I got first interested in investing back in 2017 when I kept hearing about all the money everyone was making in the stock market. I was blinded by all of those stories and I dove headfirst blindly into investing, thinking that I was going to get rich as well. But understand this, investing is not a get-rich-quick scheme. It can be a safe and smart way to grow your money if you do it properly. Now, investing isn't just about making money. That's only half of the equation. It's also about not losing it. Take this $100 note, for example. Next year, even though it's still going to be worth $100, how much you can actually buy with it or the effective value will decrease due to inflation. A 5% inflation rate makes your $100 effectively be worth $95 after 1 year and just $85 in 3 years. So if you don't want your money to slowly deteriorate from inflation year after year, then you've got to find a way to grow your money, and investing into the stock market is one of the best ways to fight against inflation. But first, you need to know the 2 main types of stock investments, and the second one is my favorite. Think of this chocolate bar here as an individual stock that you could buy and invest into. Whilst this is great, it's also super risky. So let's say you had $100,000 to invest and you decided to invest all of that money into this one individual stock here. Now let's assume that that individual stock was Facebook. Now back in September of 2021, if you had invested $100,000 into Facebook, the stock was trading at around about $375 US. But only a few months after that, your $100,000 portfolio would only be worth a little less than $50,000. Because the stock price of Facebook dropped by over 50%. Now, losing 50% of your portfolio is obviously something that we want to avoid at all costs. If you're someone who doesn't love risk and would rather avoid your portfolio ping-ponging up and down, then this is a much better approach. Instead of buying one stock worth $100,000, you could get 10 stocks worth $10,000 each and still have a $100,000 portfolio. But this way, you'll be exposed to much less risk. Even if one stock company's stock price drops by 50%, so going from $10,000 to $5,000, your total portfolio only goes from $100,000 to $95,000, so just a 5% drop of your total portfolio. Diversifying or spreading out your investments is a great way to reduce your risk. The biggest problem is researching which stocks to buy and then managing 10 different stocks at the same time. This is a lot of work, which is why my favorite way of investing is with a fund. Think of a fund like this jar of chocolate bars. Just like before, each bar represents an individual stock, which means that this jar or fund holds a bunch of different stocks. So instead of buying a chocolate bar one by one, you could just buy a jar of them and you automatically get access to all of these chocolates. Next, we need to understand the different type of funds that are available, and the last one is my favorite. First, mutual funds. Now, mutual funds have an actual person called a fund manager who actively picks which stocks and investments go into that particular fund. Now, because there's someone actively managing it, mutual funds tend to charge you higher fees, since they have higher overheads like salaries that they need to pay for. Depending on the mutual fund, there might also be a minimum investment amount that you need before you can actually own the mutual fund. Plus, they're only traded once at the end of the trading day. So even if you buy a mutual lunch during lunch, your trade doesn't actually get executed until the end of the trading day. Secondly, index funds. Now these are passively managed, meaning there's no fund manager choosing which stocks to buy, which means that these tend to have lower fees because you don't have to pay for a fund manager, and they also tend to have lower minimum investment amounts. Now an index fund is essentially a fund that is constructed to match or track a particular market index. Indexes often have rules that they follow which dictate what they have to invest into, what they can't invest, and how much they should be investing into a particular company. For example, the S&P/ASX 300 index tracks the 300 largest companies in Australia, and it uses a float adjusted market cap to determine how much to invest into each individual company, which in layman's terms simply means that the index invests proportionally based on how large that company is. The only aspect in which an index fund is similar to a mutual fund is that they are only traded at the end of the day. And finally, my personal favorite is exchange traded funds. They follow all the same characteristics of an index fund, except this time they can be traded at any time of the day, just like an individual stock. So next, how do you know which ETFs to invest into? Like, which ones are the best? Did you know that there are over 350 different ETFs currently trading on the Australian stock market? Choosing which ETF to invest into can get overwhelming very quickly. And what you need to do as an investor is essentially take this list of 350 ETFs and then narrow it down to a select few that is going to align with your own risk tolerances, investing style, and overall objectives. To help you with this, I want you to answer these 4 very simple questions. Are you investing for the long term or short term? Are you focused on capital appreciation or income generation? Do you have a low or high risk tolerance? And how important is the social or environmental impacts of the companies that you invest into? Where you fall on the scale for these 4 questions will immediately give you a general guide on your own investing style and objectives, and will help you narrow down which ETF you should choose. For example, if you're someone who's investing for the long term, focused more on income generation with a lower risk tolerance, and is conscious about the social and environmental impacts, then you might want to consider investing into an ethical dividend-focused ETF coupled with a bond ETF to smooth out the stock market volatility. Another important consideration when choosing which ETF to invest into is the expense ratio. The expense ratio is essentially a percentage of the assets that the fund charges for managing that fund. For example, if an index fund has an expense ratio of 0.2%, then this means that the fund charges 0.2% of the total assets that you have invested in fees every year. If you have $10,000 invested into that fund, then this means you would pay $20 in fees every year. Now, that might not seem like a lot right now, but the fees do add up over time if you're not careful. A high expense ratio could potentially cost you tens of thousands of dollars over the course of your investing journey. Take, for example, these 2 ETFs. The ARK ETF has an expense ratio of 0.75%, whilst the Vanguard ETF has an expense ratio of only 0.04%. If we were to invest $6,000 per year for 30 years, assuming a 7% return on investment, adjusted for inflation, you would have to pay $81,450 in fees with the ARK ETF. Meanwhile, with the Vanguard ETF, you would only have to pay $4,656 in fees. And so to keep as much money in your pocket when it comes to investing, you need to be aware of the ETF's expense ratio. Now, when you're doing your research into ETFs, oftentimes you'll run into multiple ETFs from different providers that are similar in nature. And if you're getting confused over what the differences are, then a good tool to use is an ETF comparison tool. The one I'm showing on the screen here today is a free tool offered by MOOMOO, which we'll talk about more in a second. But first, let's compare 3 popular ETFs that provide you with exposure to the Australian stock market: VAS, A200, and IOZ. With this tool, we can easily compare these 3 ETFs. We can easily compare the performance across all 3 ETFs over the past 3 and 5 years. You'll notice that even though all 3 ETFs provide you with exposure to the Australian stock market, the performance isn't exactly the same. And this is because they all track different benchmarks or indexes. If we continue scrolling down, we can see the total assets under management, and more importantly, we can see the management fee that you'll be charged across all 3 ETFs. And further down, we can also compare what stocks each ETF invests into, the weightings, as well as a sector breakdown. Aside from this comparison tool, MOOMOO also provides several tools to help you evaluate an ETF. For example, if you want to do more research into VAS, you can view the Morningstar rating for free, which is widely regarded as a reliable fund evaluation standard in the industry. As you scroll down, there is an indicator analysis which categorizes various analysis indicators into 3 dimensions, such as profitability, performance ratios, and risk hedging. And by clicking it, you can see further details. This feature from MOOMOO helps you intuitively understand the ETF's performance without having to go through fancy stock charts and financial indicators. If you want to try these tools out for free, then you can use the link down in the description. And if you're a new customer and meet certain deposit requirements, you can also receive up to 10 free stocks worth up to $3,000. Now that we've decided which ETFs to invest into, next we have to decide what investment strategy we should be following. And whilst there are multiple different investment strategies out there, the investment strategy that I'm about to share with you is the simplest of them all. It takes next to no effort and can be easily automated as well. And that strategy is called dollar cost averaging, or DCA for short. And whilst it might sound quite technical, dollar cost averaging is just an investment strategy where you consistently buy X dollars worth of a stock during a fixed integral period. For example, you invest $200 in Microsoft every single month for 5 years. If you're investing a fixed amount of money each time you buy, you'll get more shares when the stock price is lower and less shares when the stock price is higher. Over time, this tends to minimize the cost per share that you pay for a given ETF. For example, let's say you have $300 to invest. In the first month, it's at $10 per share. Then the second, it's $5, and in the third, it's worth $20. Now, if you could tell the future and time the market, then you would obviously buy all of your shares in the second month when the stock price is at its lowest. But remember, you can't tell the future. And this is where dollar cost averaging comes to play. Say you split your $300 investment equally over those 3 months. So at the end of the first month, you would have bought 10 shares, 20 shares in the second month, and then 5 shares in the third month. So now you have a total of 35 shares for your $300 investment for an average price per share of $8.57. Your price per share isn't the cheapest at $5 per share, assuming you could even tell the future, but it's also not the most expensive at $20 per share. By dollar cost averaging, it's ensuring that you're not dumping all of your money when the stock price is at its highest. And it's especially powerful during volatile times in the stock market because it stops this psychological fear that makes you scared to invest. So finally, let's talk about how to buy and sell stocks. Now first, you need to choose an investment platform. Now when choosing which platform to go with, one of the most important factors to consider is whether or not you want to go with a CHESS-sponsored broker or a custodian broker. And I'll let you know my preferred one in a second. When you buy shares through a CHESS-sponsored broker, the ASX puts your name in the owner column. This means that you now directly own those shares that you just bought. When you purchase shares via a custodian broker, the ASX puts the broker's name in the owner column. The broker then assigns you as a beneficiary. This means you don't technically own the shares you invest in, but rather the broker owns them on your behalf. Each one of these two models has its own pros and cons. With the CHESS system, it's more secure because you are the legal owner of those shares, and you can change brokers more easily because you can transfer your shares from one CHESS sponsored broker to another very easily. With custodian accounts, one benefit is that it gives you access to international markets. You see, the CHESS system is specific to Australia. So in all other stock markets like the US, they operate under a custodian model. So if you want to invest into the US markets, then you'll need to open a custodian account. Another benefit is that you can buy and sell fractional shares rather than whole shares. Now, out of these two, I prefer to go with a CHESS sponsored broker, largely due to the security aspect. Now, there are plenty of CHESS sponsored brokers to choose from, but personally, I've been investing with MOOMOO for quite some time now. They actually offer both CHESS sponsored and custodial accounts and are great for both beginner and more experienced investors. Even though they are CHESS sponsored, they offer some of the lowest fees, starting at just $3 to invest into the Australian market and 99 cents to invest in the US market. But regardless, once you've selected your broker, you'll need to deposit funds into your account in order to invest. Once you have your money deposited, next you want to place an order to purchase your ETF. You'll just need to search for that ETF that you're interested in buying. So for example, let's say you're interested in investing into VAS. Once you're on the profile, all you really need to focus on is the stock price on the top left-hand corner. Now next, you'd want to click on the trade on the bottom left-hand corner and then click on buy now. Okay, so now I'm on the buy trade order screen, and I know it seems really complicated, but there's only a few different terms that you need to be aware of. A market order means that you want to buy the stock at its current price, which is around $102, whilst a limit order, on the other hand, is basically an order to buy at a specific price or better. So let's say I did a limit order for $100, then my trade would only execute when VAS's stock price dropped down to $100. But personally, I just usually use the market order. And so you will just enter the quantity of shares. And so let's say I'm just purchasing one share, for example, and we can see here my total estimated cost for that trade. And if you're happy with everything, then you just need to hit buy and confirm the trade. And so if you've been following along, then congratulations, you've just invested into your first ETF. Now, if you're still nervous about investing, remember you can get up to 10 free shares with MOOMOO as a new user when you sign up. What's more, MOOMOO now has a strategic partnership with NASDAQ and is hosting a global US stock paper trading competition. So you can test out this whole investing thing without actually risking your own money. Every participant has the opportunity to share $20,000 worth of stock cash coupons every single week for 5 weeks. The top 3 challengers globally will even have their names displayed on the NASDAQ screen and receive up to $10,000 in the form of cashbacks for stock purchases. Each user who signs up will also gain access to NASDAQ's total view market data as well. This competition will only last until November 16th, so join now. The next big question that you probably have is, when is the best time to invest? And yes, there is a best time. Albert Einstein once said that compound interest is the 8th wonder of the world. He who understands it, earns it. He who doesn't, pays it. Compound interest is the reason that you should have started investing yesterday, but only if you can check off these 3 boxes first. Have you paid off all of your high interest debts? If your debt's interest rate is greater than 8%, I would prioritize paying that down first. Do you have an emergency fund saved up with 3 to 6 months worth of living expenses? And do you plan to invest for the long term with money you don't need in the next 5 to 7 years? If you can tick all 3 of these boxes, then you've basically got the green light to begin investing. And truthfully speaking, there isn't really a bad time to invest if you plan to invest for the long term. For example, let's check out the NASDAQ index. Let's say you bought the ETF at its peak for just under $52 in October 2007. Then in 2008, the financial crisis hits and the ETF plummeted down to $26. And it sucks because you just lost 50% of your portfolio. But remember, you're thinking long term. You haven't actually lost anything yet because you didn't sell those ETFs. And if you just kept holding and left your money invested, then in October of 2010, you would have made your money back. And by September 2012, the ETF jumped to over $70 a share. And in 2021, it was over $400 a share. That's nearly an 800% gain, and that's the beauty of long-term investing. So the thing you need to realize is that you can't time the market, and the best strategy is just to continue investing and holding for the long term. And I get it, the media will always have some kind of scary "the world is ending" headlines, that the market is going to crash. But here's a trade secret. Most investors and professionals on Wall Street, they don't buy into this fear because they know that the stock market will always go up in the long term, regardless of the ups and downs in the short term. Despite all the crashes, all the recessions, and all the crises that we've experienced, the stock market will always go up in the long term. So focus on the long term and not the short term, and just remember that the best time to invest was yesterday and the next best time is today. So that's everything that I wanted to cover off in today's video. Hopefully, if you have been considering investing into ETFs for the first time, this video has been useful to you. So if you've made it this far in the video, drop me a comment with the word silver down below so I know you watched all the way. And if you've enjoyed the video or found any value at all, it would help me out greatly if you could go down there and hit the like button and subscribe for more personal finance content in the future. And if you want to know the simplest 2-fun ETF portfolio that you can invest into, then you might want to check out this video right here.